The economic data is clear. The market has pulled back, and quality stocks are discounted. But here's the problem most investors face. How do you know if a stock is cheap because it's a bargain or cheap because something's broken? Today, we're using the PEG ratio to identify 10 high-quality companies down 15 to 43% from their highs that are still reasonably valued for their growth rates. The PEG ratio is simple but powerful. Take the price-to-earnings ratio and divide it by the growth rate. A PEG under 1 suggests the stock is undervalued relative to growth. A PEG under 2 means you're paying a reasonable price. Over 3, you're likely overpaying. Every stock on this list has a PEG at or below 2, meaning despite sell-offs, growth hasn't disappeared, it's just cheaper. Starting with the smallest discount, Microsoft, down 16% with a PEG of 1.58. Microsoft isn't deeply discounted because the market still trusts the business. Azure cloud growth continues. AI integration through OpenAI partnerships is driving enterprise adoption, and Office 365 subscriptions provide recurring revenue. A 1.58 PEG says you're paying slightly more than 1x growth, which is reasonable for a dominant, diversified tech giant. This is the conservative play, less downside risk but also less upside if it rebounds. Uber at negative 17% and a PEG of 1.11 is interesting. Rideshare has matured, profitability is improving, and the valuation is attractive. Synopsys and Arista, both down around 17 to 20%, serve AI infrastructure with chip design software and data center networking. These aren't household names, but they're critical picks and shovels plays as AI scales. Mercado Libre, down 20% with a PEG of 1.07, is one of the most attractive valuations on this list. They dominate Latin American e-commerce and fintech through Mercado Pago. Emerging markets are volatile, but Mercado Libre's growth trajectory is intact. That 1.07 PEG suggests significant undervaluation. Old Dominion Freight, down 23%, is the efficiency leader in less-than-truckload shipping. Freight is cyclical, which explains the sell-off, but over multi-year periods, ODFL's operational excellence creates value. A PEG of 2.0 is fair here, not cheap, but not expensive. Now we enter deep discount territory. Intuit down 33% with a PEG of 1.63. This is QuickBooks for small businesses and TurboTax for consumers. Intuit has near monopoly positions in both categories. Why the sell-off? Concerns about AI disrupting tax software and small business accounting. But Intuit is integrating AI into their products, not being disrupted by it. At a 1.63 PEG, you're getting quality software with recurring revenue at a significant discount. FICO, down 34% with a PEG of 1.72, is fascinating. Your credit score is a FICO score in most cases. They have a literal monopoly on credit scoring in the United States. The sell-off likely reflects concerns about consumer credit quality and interest rate impacts on lending, but FICO's business model is providing scores, not extending credit. They get paid regardless of economic conditions. This is infrastructure for the financial system, and at a 1.72 PEG after a 34% decline, it's compelling. Netflix and ServiceNow anchor the deep discount tier. Netflix, down 35% with a 1.59 PEG, shows streaming has matured but remains profitable with 260 million subscribers. Growth has slowed, but at this valuation, you're not paying for hypergrowth, you're getting stable cash flow cheap. ServiceNow, down a staggering 43% with a PEG of 2.0, is the biggest discount on the list. This is enterprise workflow automation software that companies can't rip out. A 43% drop to a 2.0 PEG screams opportunity if you believe in their long-term growth. Here's how to think about this list. If you're conservative, focus on modest discounts with lower risk. Microsoft, Uber, Synopsys, and Arista. Medium risk tolerance? Add Mercado Libre and Old Dominion for cyclical and emerging market exposure. Aggressive investors hunting value? Intuit, FICO, Netflix, and especially ServiceNow offer the biggest discounts with PEG ratios still indicating reasonable valuations. You could build a diversified portfolio across all 10, allocating 40% to Tier 1, 30% to Tier 2, and 30% to Tier 3. This balances safety with opportunity. The key insight: every stock has a PEG under 2, meaning none are egregiously expensive despite different levels of risk. 10 quality stocks, 15 to 43% discounts, all with PEG ratios at or below 2, meaning growth hasn't disappeared, it's just cheaper. Markets sell off quality and junk together. Your job as an investor is to identify which sell-offs create opportunities. The PEG ratio isn't perfect, but it's a simple filter to find growth at reasonable prices. These 10 companies pass that test.